Something strange is happening with your money right now. If you've been holding standard tech stocks through 2026, you are probably physically exhausted. One week, the market hits an all-time high, and you feel like a genius. The very next week, someone sneezes near a central bank. Panic selling sets in, and your portfolio gets hammered. But while the day traders are actively losing their minds and their money, a very specific group of investors is sitting back, sipping their coffee, and quietly getting richer. They aren't trying to time the market. They are using the most boring, grandparent-approved financial strategy on the planet, dividend investing. Relying purely on a stock's price going up is a dangerous way to build wealth in a swinging market. But forcing companies to pay you cold, hard cash just for owning their shares creates a psychological defense against the chaos. Let's say you have $100 and you decide to buy a goose. Most people buy a goose, feed it, hype it up on the internet, and hope that in 5 years someone else will buy it from them for $200. This is called capital appreciation. You are praying that eventually someone pays you more for that asset than you paid. But if the goose market crashes and nobody wants to buy it, you have zero money. You are just stuck holding a bird. Now imagine buying a completely different kind of goose. This one isn't flashy, but every single month it lays a golden egg. Even if the overall price of geese drops by 50%, you are still collecting those eggs. This flowchart illustrates exactly what those golden eggs actually are. A dividend is simply a profitable company deciding not to spend all its cash on a fancy new office, and instead depositing a portion of that profit directly into your pocket. You don't need to sell the goose to make money. By generating your own independent cash flow, you separate your financial success from the unpredictable short-term resale value of the stock. For the last decade, people hated golden eggs. We lived in an era of 0% interest rates, where borrowed money was essentially free. A safe, predictable 4% cash payout felt pointless when a tech startup was promising to double your money in 6 months. But then the free money stopped. The Mars colonies got delayed, and the boat started rocking violently. Those flashy companies began to plummet. If you are standing on a violently pitching deck, a dividend acts as the safety railing. Holding on to the railing might not make you look cool, but it absolutely stops you from falling into the ocean when things get rough. Let's put specific numbers to this. Imagine you invest $10,000 into a stock, and the market immediately throws a tantrum, dropping the price by 20%. When the market is this unpredictable, a company's ability to generate actual, distributable cash becomes a primary source of stability for your portfolio. This split screen compares your options. Left, a growth stock drops, and your $10,000 becomes $8,000. Right? A dividend stock takes the same hit, but its yield generates $500 in liquid cash, looping down to automatically buy more shares. By buying more shares at the bottom, a market crash mathematically accelerates how fast you accumulate equity. What looks like a painful paper loss to everyone else actually gives you a direct purchasing advantage. To actually execute this strategy without lifting a finger, you check a single box in your brokerage account to activate a dividend reinvestment plan, or DRIP. If you own 10 shares, the dividend buys a fraction of an 11th share. Next quarter, your payout is slightly larger, increasing the size of your base. The cycle spins faster and faster, acquiring equity without any additional effort from you. If you look at the total return of the stock market over the last century, a massive chunk of the profits didn't actually come from stock prices drifting upward. They were the result of those dividends being consistently reinvested. DRIP operates completely independently of whatever panic is currently happening on Wall Street. It uses time and geometric compounding to systematically eat through periods of market stagnation. Once you initiate this engine, something strange happens to your brain. It completely reverses how you feel about downward market volatility. Instead of panicking, you start actively hoping the market drops. Every time the price dips, your automated dividends gobble up more shares on the cheap. But before you dump your life savings into the highest paying dividend stock you can find, you need to understand exactly what you are walking into. A double-digit percentage payout looks incredible on paper. But prioritizing a massive yield without looking at the underlying health of the company is a trap. If the company is dying, that shiny golden egg is just bait. and chasing it will completely wipe you out. You log into your brokerage app and start hunting for dividend stocks. Immediately, you see Company A offering a nice, safe 3% yield. But right below it, Company B is offering a massive 15% payout. Why settle for 3 when you can take 15? Here is the brutal truth about the stock market. A 15% dividend yield is almost never a gift. It is a distress flare. Yield is the annual payout divided by stock price. A $100 stock paying $5 gives a 5% yield. But if the stock crashes to $25, the math updates. $5 out of 25 makes the screen spike to a 20% yield. The payout isn't actually going up. The underlying company is broke, and they are absolutely going to cut or cancel that dividend next month. If you buy the stock just because that percentage looks high, you are stepping into a yield trap. It's the financial equivalent of buying a parachute at a 90% discount because it has a giant hole in it. You might feel like you saved money up front, but the outcome is going to be incredibly messy. Chasing artificially high yields doesn't multiply your money. It simply locks your capital inside sinking assets until there's nothing left. What you actually want is a safe, growing yield. These come from companies with long histories of increasing their payouts every single year. Businesses often called dividend aristocrats. They sell the boring, everyday things people buy regardless of the economy. Things like toothpaste, basic toilet paper, and trash collection. Understanding why these boring companies matter is crucial right now, because the defining feature of the stock market over the last decade has been the buildup of unrealized paper wealth. If your house goes up in value by $200,000, you feel rich, but that money is trapped. You can't actually spend it at the grocery store unless you sell your house and go live in a tent. A portfolio of volatile tech stocks works the exact same way. A bad earnings report or a new government regulation can erase 30% of your net worth overnight. And you cannot pay your electric bill with the unrealized gains of a tech startup. Dividends bypass this vulnerability completely. They convert that fragile, imaginary paper wealth directly into tangible, spendable cash flow. The smartest money on Wall Street knows this, which is why they shift gears during sideways markets. When a market just chops up and down without actually going anywhere, capital gains disappear. This chart shows exactly how that plays out over a flat 5-year period. A pure growth investor makes exactly 0%, but a dividend investor, pulling in and reinvesting just 4 or 5% a year, ends up 25% higher from doing absolutely nothing. You don't have to sell all your high-flying tech companies, but you do need to balance the ship. You need a sleep-at-night portfolio. Think of your portfolio like a basketball team. Your growth stocks are your star players, taking wild 3-point shots. Sometimes they score big, and sometimes they miss terribly. Your dividend stocks are the defensive players, the big, slow guys who stand near the hoop and grab rebounds every single time, securing a steady stream of baseline points. Yes, unless you use a tax-advantaged account, the government will take a cut of those dividends. But complaining about paying taxes on cash flow is like complaining your wallet is too heavy. It is a fantastic problem to have. By anchoring your erratic growth players with steady dividend producers, you structurally lower your overall volatility. Even if the market throws a complete tantrum tomorrow, your defensive players guarantee baseline liquidity. While we treat investing as a math problem, our survival depends on biology. Human brains are simply not wired for the stock market's fluctuations. We are wired to run away from danger. When we see a screen full of dropping red numbers, our brain releases stress hormones. It physically screams at us to sell everything and hide our money under a mattress. Dividend investing hacks this biological response. Instead of fixating on the daily, uncontrollable price of a stock, your focal point becomes your annual dividend income, which steadily goes up. Imagine logging into your account during a 500-point market crash. Instead of staring at your total balance in a panic, you check your dividend tracker and see a guaranteed cash deposit scheduled for next month. The panic immediately drops. You stop playing the casino game of guessing which line will go up, and you start playing the business owner game, accumulating assets that pay you just to own them. Surviving the next market whiplash requires building a relentless cash flow engine. This strategy removes human emotion from the equation by focusing on utility over speculation. At the end of the day, You can't feed your family with a stock chart. You can only feed them with cash.